All right, everyone, here we go again. I don't know what just happened, but I'm not gonna let it worry me. I'm just keep on moving, right? I'm just gonna go ahead and keep moving through this. Okay. Now I don't even know what happened with my screen here. But you know what? I'm not gonna worry about it. I'm gonna just keep on moving. I'll figure it out later. I will figure it out later. Because I cannot see what's happening over here. Anyhow, so we were talking about before my screen froze and went out and whatever. I don't know what's going on. I don't know if it's my computer or Facebook or what. I had some issues with my, hey Cheryl, hi Simone. I had some issues with my computer a few weeks back. It wasn't taking a charge, and I sent it to Best Buy to be repaired. They replaced the battery in it and a couple of other parts. And it seemed like it came back worse than when it left. So I don't know. I'm gonna have to talk to Best Buy, see, hey, what's going on, Derek? So I'm gonna have to see what's going on with that. But anyhow, Mr. Hodgson's Dynex. So anyhow, so we're gonna talk about this term insurance again. I can't see who's in my room for whatever reason. I can't clear this screen, but hey, whatever. It is what it is. So so term insurance, there's two characteristics of term insurance. Number one is that it will not pay out unless you pass away, right? You have to pass away for it to pay out like any other insurance. But the thing with term is that it rarely pays out. It's about 3%. It rarely pays out because it's set to expire. The whole idea of term is that it terminates at a certain period of time, whether it be 1 year annual term or 5 years or 20 years or whatever the term is, it terminates. So it's very rare that it pays out, right? Hey, Tracy. Term insurance is generally, and I'm looking away because I got some notes over here, y'all. Try to keep my thoughts in order. So term insurance is generally attractive to individuals between the ages of 25 and 54. The reason being is because term insurance is low cost. So because of the low cost, young people in their 20s and early 30s, they are attracted to term insurance because they can afford it. They haven't yet really built their income, so they can afford it. So 20-year-olds, the 20-somethings, they buy a lot of term. They can't afford it. They can get large sums of term for little or no money. For $60, I have my daughter and my grandson insured for about $500,000, and I think I pay about $60. So you can get large sums of term insurance for little or no money. So it's very attractive to a younger crowd. It's attractive to individuals in their 40s and 50s because they're able to fill in the gap where whole life has left off. So you may want to make certain that your minor children are cared for or gets to college in the event that they pass away while they're still young, and you want to make sure that you can pass that money to somebody who's going to take care of them properly so that they can have a fair chance in life. So it's attractive to individuals who are young, just starting off and building their income, and then it's also attractive to individuals who are building their families. And so term insurance works very well in those instances. There's two term policies that are more common than the next. That's a 5-year term, and then you have the 20-year term. Those are really the most common. The 5-year term is the one you generally see that comes in your mailbox. And actually, I had one I was going to share with you guys. I don't think I brought it down, but I just received an offer in the mail today, and I wanted to show you the 5-year bands. So on the back of these insurances that come to you, these insurance officers that come to you in the mail, it'll have these little columns, and it'll say, okay, if you're between this age and this age, this is how much your insurance is going to cost you. And then as it gets, your age gets higher, it costs more. But a lot of people just look at that and say, well, oh, I'm between 40 and 45, so I pay this amount, and they kind of ignore the rest. Well, what the rest of them are showing you is that this is what you will pay once you hit this age. And a lot of people ignore that. And I wanted to share with you the one that I received, because it said that for a male between the ages, I believe it was 70 and 74, if that male was a non-smoker, it would be, I want to say it was $1,248. And we're talking month. $1,248 per month. Now, the price is outrageous, but they know no one's going to purchase that. No one's going to purchase that. They will, they make their money by selling the policy while you're younger and the price is inexpensive. And they know that they are not going to pay that out because they know you're not going to pay $1,248. If you were a smoker, I think it was like $1,500 or something crazy, right? So they know you're not going to pay for it. Now, a lot of people wonder, well, why is this even legal? Well, it is. It's insurance. And to be honest with you, your car insurance is a term insurance. Your homeowner's insurance is a term insurance. It's annual renewable, right? Well, car insurance is actually renewable every 6 months. Every 6 months, you have to get a new, updated policy. Your price may have increased depending upon whether or not you had accidents and tickets. It decreases and so on and so forth. So you already are doing annual renewable term right there. Okay, this is just with your life. So, it's legal. It's always been legal. It's going to always be legal. But again, term insurance fills in the gaps where other insurance can't go, right? So then, like I said, it's popular for ages 25 to 54. The common ones are 5-year and 20-year. The 20-year insurance work very well for people with small children. It works very well for people with mortgages. You can get a 30-year or a 35-year in certain agencies, and those work very, very well for people with mortgages. You get that term insurance equivalent to the amount that your mortgage is and for the length of time that you have to pay on that mortgage. You got a 15-year mortgage, get a 15-year term. If you got a 30-year mortgage, get a 30-year term, but you want to make sure you get it in the amount that that mortgage is. That way, if you pass away when that term is in effect, then your mortgage can then be paid for, especially if you make the mortgage company the beneficiary. Now, if you make your spouse or someone else the beneficiary, we can't guarantee that they're going to pay off the house. But if you make the mortgage company the beneficiary, it can indeed pay off your house. And what's left from that then goes back to whoever you have listed as the remaining beneficiaries. So a lot of people aren't aware that you can make your insurance company, your mortgage company your beneficiary, but you can do that just like you can list your church, any charitable organization. One of my coworkers, they attended a college, I can't recall the name of it. Not them, their client attended a specific college. They had no children. They wanted to make certain that when they passed away, they had $500,000 that they were leaving to the school, because they felt, if it were not for this particular college education that they've given me, I would not have been able to accomplish all of these things, or whatever his accomplishments were. So he was giving back, and he was doing that through life insurance. That's what's called charitable giving, which we're not going to talk a whole lot about. We might if people are interested, but I'm not going to really talk too much about charitable giving, but that's what that is. It's called charitable giving. And when some people refer to it as legacy giving, but term is really good for that, where you can leave large sums of money to take care of a specific situation. So how is, term insurance renewed, right? It cancels, it expires at a certain period of time, but when, as we were getting cut off, what I was sharing was that, a lot of companies will continue the term insurance even after the term. And so what happens is, like, let's say you have a 20-year term insurance, the policy terminates or expires. But what happened is that next year, that insurance is now a little higher. So let's say for the first 20 years, your premium was $20. So at year 21, it'll continue, but now it continues as an annual renewable term. So year 21, it may be $21. Year 22, it may be $22, and so on and so forth, till, let's say, you're 70 and it's like $800. And that's not an exaggeration. Look at some of those mailers that you get in the mail. Today I got one from, well, I don't want to blast companies. I got one in the mail today, so you probably got one in the mail today too, because they kind of generally just drop them all at the same time. So check your mailbox from now on, start looking at those things, read the fine print, understand what it means when it says banned, 5-year ban. They're looking at every 5 years that policy increases in price. So that's a 5-year renewable term product, right? Now, with term insurance, when they're renewing after the specified period of time, one good thing about term insurance is that you don't have to give evidence of insurability, meaning once you've health qualified, you don't have to go back and, prove you're healthy or take blood tests or anything like that again. Once you're in, unless you get out and then decide to get back in. But once you're in. So you get to renew this every year with the guaranteed insurability, right? You don't have to show proof of, of what, as we call it, evidence of insurability. You don't have to prove that, right? However, there's some other really cool things about term. So we're going to talk about the 4 types of term insurance. So one type is the level term. And it's pretty much self-explanatory. Level term is term insurance that stays the same price straight across, right? For the life of the policy, the premium amount is the same. It's level. It doesn't change. It doesn't decrease. It doesn't increase. If you're paying $50 today, you're going to pay $50 next year. You're going to pay $50 in year 15. You're going to pay $50 in year 20. Year 21 is a whole different scenario, but as long as you got that policy, it's going to be the same amount that you've paid for at day one. So that's level term, right? Very self-explanatory. Whole life is level as well. Whatever you pay today is what you're going to pay for the duration of the policy. But then you also have term insurance that has a conversion clause. Not all term policies give you a conversion clause, but some term policies come with a conversion clause. And that conversion clause says that you can convert this term policy to a whole life policy if you convert it by the time you reach X amount of years, right? By the time you reach, let's say, age 70, or you can convert it, before you reach age 65 or something like that. Or it may say you can convert this policy if it's converted within the first 15 years, or it can be converted within the first 10 years, or whatever that stated period of time is, whether it is in years or whether it's in age. Understand that it can be converted. So this is a benefit to you if you have convertible term, because let's say you got $500,000 in term when you were young. Let's say when you were 20, now it's renewing, you're at 40, and it's you say, well, hey, I want to get an additional 20 years worth of term, whatever is going to increase based upon your current age, which will still be kind of low at age 40. You keep that for a few years, and then you say, you know what, I want to convert it. And it's going to convert based upon how much whole life would you have been able to get paying that same amount, right? And so you may be, you may have 500,000 in term, but you may only be able to get, let's say, 100,000 in whole life is still a win, right? And you may want to convert it because now maybe your children are older, right? Or some other circumstance change. Maybe you're starting to see members in your family having the same illness. Maybe a lot of your family members are dealing with cancer, or maybe your family members are dealing with heart attack or stroke. I sat with a young lady maybe a year and a half ago, and her and I had this conversation, and she mentioned to me that her mom passed away from cancer. And she says, you know, I had a sister, she passed away as well. I said, oh, I'm sorry to hear that. You know, what did your sister pass from? She says, cancer. Okay. And then she says she has an aunt passed away from cancer. Everything we talked about, her family members, the women in her family have passed away from some form of cancer. And so I looked at her and I asked her, well, what kind of insurance do you have? She had a term policy by a company that I know does not have convertible term. And I told her, you know, with this type of policy, you can't do anything more with this than what you're already doing. And because of the fact that your family has a history of breast cancer or cervical cancer, you may want to consider right now getting some type of whole life policy, or at least a term that's convertible, because in the event that something happens, you know, let's say year 21 and the term insurance is over and done, or whatever the case may be, now you're uninsurable with most companies, right? You're uninsurable with most companies unless you do what's called a guaranteed life issue. And we'll talk about guaranteed life when we go into different types of whole life insurance. And so, you know, you really need to, if you have term, you really need to read the fine print or get your insurance company on the phone and ask them, can this be converted? And if so, at what point and at what rate? So that you can get your, you know, ducks in a row. Because if there's a family history or something, you don't want that term policy to terminate on you, and now you're uninsurable because there's something else happening. Or let's say, you know, over the past 30 years, you've gained weight, and all of a sudden now you no longer heighten weight qualify or meet what we call the bill. And so now you're disqualified for most companies, and most companies utilize the same bill charts. So you know, there's a lot of things that you want to make certain that you avoid. And so if you have term insurance, now is the time to take a look at that policy or contact your company and ask them if that policy can be converted. If it cannot be converted, I strongly suggest that you talk with someone else about getting some whole life insurance. Now, of course, and I'm gonna just keep it real. Of course, I want you as my client. I want you to, you know, utilize my services. Of course, this is how I eat. This is my bread and butter. But at the end of the day, most importantly, I care about your well-being, which is why I'm on Facebook talking to people about life insurance, because it's not something that you hear about on Facebook, but it's something that we always have to come across when we lose a loved one, right? And then a lot of times we don't understand the intricate details of it. So I'm just educating people. And so you need to really be mindful of the fine print. If you don't understand how to read your policy, get your insurance agent on the phone and tell them, look, I need to make an appointment. I need to set up an appointment because I need to understand the words written on this page, right? Before it's too late and things happen and it can't be reversed. So make sure you do that. So make sure you talk to your insurance company. If you have a term policy, find out if that term policy is convertible, and what rate, and at what point can it no longer be converted, and start trying to get some stuff converted over to whole life. That way you make sure that you're set, because you do not have to show evidence of insurability, okay? And then also there is decreasing term, right? There's decreasing term. A lot of mortgage companies offer decreasing term insurance. A lot of insurance companies that provide you your homeowners insurance provides also decreasing term, and they call it mortgage protection insurance, right? Mortgage protection insurance is how they'll package it most times. And I remember when I purchased my first house, I think I was 27 years old, and I'm like, oh, I'm doing something, right? I didn't have, I had a degree in computer programming at the time, and a background, a minor in accounting. But I was young. I was 27. I had just graduated college at 21. So I really wasn't, well versed as I am now. I've been in this business now way over 20 years. So now, I'm more, I understand the details and the fine print in the game, right? And so here you got this decreasing term insurance, which a lot of mortgage companies will push off on you and say it's to protect your home. But here's where things get slick. The premium is level. The premium stays here, right? The premium is here, right here. But as your mortgage decreases, right? Let's say your mortgage is, 150, 200,000, whatever. As you pay off your mortgage and that mortgage decreases, right? So does your insurance, it decreases. So remember I said that when you buy insurance to cover a mortgage, you want to make sure to get the same amount of coverage as your mortgage. And you want to get for the same at the top. So if your mortgage is 250, you want to get 250,000 in life insurance. If you get it's a 30-year mortgage, you want to make sure that your life insurance is 30 years. But with decreasing term, what happens is that as your $250,000 mortgage decreases because you're paying it off, then the term face value also decreases. It's going from 250 all the way down, right? So it's coming down as well, but your premium is still the same. Your premium doesn't change. The premium is level. So if you're paying, let's say $100 for the $250,000 in term, you're going to pay $150 dollars. I'm sorry, if your premium is $100, your premium is going to always be $100. So if your term product is $250 at the start, and now 10 years later is $175, you're still paying $100 a month. Let's say now all of a sudden your mortgage is $100,000. Your insurance is $100,000 and you're still paying $100 a month. Let's say all of a sudden now your mortgage, you only got $12,000 left to pay for your mortgage. Your life insurance is $12,000 and you're still paying $100. Your mortgage is now down to $5,000. Your life insurance is $5,000 and you're still paying $100. So the premium stays level, but the coverage itself dwindles down, hence the term decreasing, and it decreases as the mortgage decreases, not necessarily in the same manner. It may be a few dollars different and stuff because the mortgage is based upon amortization. Life insurance is just based upon whatever, fractions they decide to use, maybe 250,000 divided by 30 years or whatever case, and decreases that amount per year. However they do it, the bottom line is your insurance decreases when your mortgage decreases, but your premium remains the same. So you want to make sure you be very mindful of when someone says, hey, I got this mortgage protection insurance. Like, oh, okay, let me take a look at it. That's what you do. Don't just go signing no papers. Take a look at it. Or better still, just find somebody who's going to be as real with you as I am, who's going to give you all the information, and then you utilize their services. Ask them, look, give me a term insurance policy that's going to stay $250,000 until the end of the term, and not just going to dwindle off. Because if you're going to pay $100 for something, you should get $100 worth of coverage, for the duration, not, just bits and pieces. Who wants to pay $100 for $5,000 worth of insurance? That just makes absolutely no sense to me. But this is what decreasing term is, and it's out there. It's been out there for a very, very long time. Then another type of insurance out there is return of premium, right? So the return of premium term insurance is just that. It returns your premium. If you have not passed away at the end of the term, they will return your premium. Sounds good? Of course it does. But there's always a trick to it, right? So return of premium term insurance is going to cost you anywhere from 2 to 4 times more than the normal term insurance. So if that's the case, why not just get whole life that's going to build up cash value, right? Now, there may be some instances where the return of premium makes more sense. I haven't seen any. I actually don't sell this type of insurance, but there are some companies out there that does. I do sell, I do offer a product, a critical illness product that has the return of premium. It covers cancer, heart attack, and stroke. If you have not utilized that service, that coverage, made a claim against that coverage within a 20-year period, it will return your premium. Right, it will return your premium and then continue on with the policy. But I don't market return of premium term insurance. But again, it's 2 to 4 times more expensive than regular term insurance. And what happens is that, anytime somebody's going to give you something back, it's going to cost more. It just goes without saying. Anytime somebody's going to return something, it's gonna cost more. And so because of that, what's happening is that they're dropping that money into the stock market, or they're dropping into futures and options and things like that in order to level up, so to speak, and make their money back. Because when they return your premium, now they've had your money invested for X amount of years, and now they've gotten a return on their investment. And so it, the goal is to hopefully it equals to the amount you would have paid if it were just a regular term policy, so that when they return your premium, they actually have lost nothing. They're giving you back your premium, and then they've used your money to leverage and come up and pay off the policy in the event. In the same way, had you purchased just a traditional term policy. Can't even get the words out. Hopefully that made sense. So that's what that is there. One thing about, I don't think I mentioned, but one thing about the convertible term insurance, there's 2 really great things about convertible term. One is the fact that it can be converted. That's number one. And the second thing is that when it's converted to whole life, you don't have to prove that you're medically qualified. So let's say, 15 years down the line, you have, severe asthma or COPD or any number of ailments. This is life, right? It happens. You can have all types of health issues. They're not going to stop you from converting it. You've already had the insurance and you're already qualified. You're just changing what you have, right? So you don't have to have someone else to do blood and urine. You don't have to worry about whether or not you meet height and weight requirements or anything like that. You don't have to worry about pre-existing conditions. You already have the insurance. All they're doing is exchanging one product for another product, right? For the same dollar amount that you're paying. The goal is the same dollar amount, but in some cases that's not the case. You may have to pay a little extra, and still that's fine. When you think about the price you pay if you went and got new insurance at that age and at your current health, you may be out of pocket far more than you would be if you're converting the policy you already have. So again, it behooves you to get on the phone with your insurance company. If you have term insurance, find out, hey, is this term insurance convertible? When can it be convertible? When is it too late to be converted? At what rate, so on and so forth. Especially if you have a history of illnesses within your family and you're starting to see some things happen and you're starting to be worried a little bit about whether or not you're going to have some of those same hereditary illnesses. You want to make sure that it can be transferred and taken care of without any medical qualifications. So that's really about all that I have today when it comes down to term insurance. We are going to talk a few more times during the week about some other issues. We're going to talk about the different types of whole life insurance. And we're going to talk about a few other things because, like I said before, insurance gets a little deep sometimes. There's so much information that it kind of just gets, you know, it falls in the cracks because people don't, they don't fully understand it. So they get locked into something either they don't understand, something they didn't need, something they didn't want, and could have possibly benefited from something different. We're going to also talk sometime this week. We're going to talk about the many excuses that I hear when it comes down to life insurance. You know, and one of the top ones is that I can't afford it. And so because of that, I will be having a webinar May 1st. Write it down, May 1st, I will be having a webinar. We're going to talk about some saving strategies. We're going to talk about some things that you can do in order to make certain that life insurance becomes a priority and affordability is not an issue for you. So that will be May 1st. We're going to talk about some saving strategies. It will not be on Facebook. It will be a webinar. So I need you to register for that event. You can go to bit.ly/saving strategies, saving, no S, saving strategies 2019. That's bit.ly/saving strategies 2019. Register there for me. You'll get a link on May 1st in order to join in on that webinar. So again, like and share this post, share it with your friends and family, share it with anybody that you care about who you feel needs, and that should be everybody who you feel needs to be educated on insurance, different types of insurance, and why we need it. There's a couple of other videos that I've posted from last week. They will not be up forever because eventually they're going to be pulled down, packaged, bundled together, and it's going to be offered as a an informational course. So with that being said, don't forget bit.ly/saving strategies 2019. Register for that, register for that, register for that on May 1st. Invite your friends. bit.ly/saving strategies 2019. It's a free webinar. There's no cost, but I need you to register for that because it will not be in Facebook. So with that, as always, take care, be safe,